Welcome to part 7 of the video series. This one is all about the income statement. So we talked about balance sheet, so vital. Well, guess what? Income statement is just as vital. You know why? Because income statement is the statement that's going to show you the revenues coming in. It's going to show you where money's going. Is research and development taking money? Is this taking money? Is taxes taking money? It's going to show you all that. It's going to show you the net income. So the categories that are most important for me as an investor in a company, by far and away, I'm looking at the revenue, I'm looking at the net income. Those matter more than anything. I also pay attention to what's going on in research and development. I also pay attention to, what is the company being taxed as far as tax rate. I pay attention to all that. You can see all that on the income statement. But the majority of the time, I'm looking at revenue, I'm looking at net income. So at the top of any income statement you look at, it's going to be total revenue. The total revenue coming in the company, right? So what I like to see is I like to look at the last 3 years. Why the last 3 years and not the last 5 years, 10 years? Well, if you're looking so far back like that, it's really irrelevant. It's irrelevant to me what Apple was making in revenue 7 years ago. It's completely irrelevant to me. It could be fun to look at, but as far as making an investment decision, it's irrelevant. I'm looking at the last 3 years. That's the last 36 months the company had. How are the revenues trending? I like to see a strong upward move. I'm a value investor, but I'm a growth value investor. So I'm really looking for companies that are growing revenues by 10% or more. Okay? Doesn't mean I'll never invest in a company that's growing less than 10%. Doesn't mean, just because a company hadn't grown the last 3 years doesn't mean it won't grow, substantially next year or something like that. But generally speaking, I like to see companies that are growing revenue each year, year over year, 10% per year. And I'm looking at that in the income statement. You can do the simple math on that. To figure out if the company's growing 10% or more. Then what I'm looking at is, once again, I'll look at all the categories, but the other category I'm really looking at is net income attributable to shareholders. That's the money that's really being able to go towards shareholders, and they can do whatever they want with that money. They can pay that out in dividends. They can just put that on the balance sheet so it can sit in cash and all those kinds of things. They can buy back shares with that money, whatever. I want to see what type of profitability that company has. Once again, I'm looking for a company that's net incomes are also going up 10% or more per year. But not only that, I am also looking at, is the net income growing faster than revenues are growing? So let's say over the last 3 years, revenues have gone up 30% total, okay? Let's say that. Revenues have gone up 30%. I want those net incomes to have gone up at least 30% over the last 3 years, and I really want them to be going up 40, 50, maybe even 60% over the last 3 years if revenue went up that much, guys. So why do I want that? Why do I want a net income growing faster than revenues? Well, at the end of the day, net income is what's actually attributable to the shareholders, and that's the profits at the end of the day. That's what's left over at the end of the pie. So obviously I want net income as high as possible because then they can use that money to pay back to me as a shareholder in the form of dividends. They can buy back shares. They can do a share buyback, which would basically take more shares off of the market. So then, if more shares are taken off the market, then generally speaking, that's more money that can go to you as a shareholder because there are less shares to be counted against the company. Also, when I'm looking at this, guys, I'm looking at like why would a company's revenues, let's say, go up 30% and their net income only go up 10%? That would be a huge issue. That means they're just growing revenues for the sake of growing revenues, or they're totally out of whack as far as their spending goes. Maybe they're just spending insane amounts on research and development. Maybe they're spending insane amounts on. Maybe they're just not making the margins they can make on that. Maybe the whole industry's struggling. And you can find all this information out in those 10Ks, 10Qs. You can find out why revenue grew this much, but only net income only grew this much. But I find that a troubling sign sometimes when companies' revenues are going up much faster, but they're becoming less and less profitable as those revenues go up. That's a scary thing for me because generally speaking, that means they're exhausting how much revenue that can come in the door, but they're going to become less and less profitable over time, generally speaking, guys. So I like to see net income growing faster than the revenues are growing. If it's not, then that's really scary. And I'm really paying attention to those last 3 years. But once again, I want to reiterate, just because of what's happened in the past, that does not mean that's going to happen in the future. That just means the trend is going your way. And also, like I talked about before, just because a company maybe hasn't grown 10% a year over the last few years or whatnot, or 20% or whatever, it doesn't scare me away from the stock, because maybe there's something changing with the company now that it's gonna, the growth rates will get much and much better. For instance, we've talked a lot about Apple in this one. I like to talk about that one a lot, by the way, not because I'm literally don't even own any Apple shares. I just love to talk Apple for the simple fact that almost anybody understands Apple and kind of the things I talk about with Apple, even if you don't understand the stock market and business and a lot of that kind of stuff. So, you know, for instance, when Apple launched the iPod, if you saw the vision for the iPod, obviously there was a huge opportunity that the company could grow way more than 10% per year, even though they probably had in the last few years. So you got to kind of view, you know, what a company has coming up for products, services, where's the industry trend going, all those kinds of things, guys, and then you can make your decision. But generally speaking, income statement, I like to look at the revenues, I like to look at the net income, I like them all to be growing at least 10% per year, and I like net incomes to be growing at a faster rate than revenues, because that means the company's getting more and more profitable as they're getting more revenue in the door, rather than just, you know, growing for the sake of growing at the end of the day, guys. So that is what to pay attention to on income statement as an investor. That's what I pay attention to, and I hope you guys enjoyed this segment. On the next segment, part 8, we're going to talk about executive management, how to decide whether a company has a good executive management team that's going to make you a lot of money over time, or a bad executive management team that's going to cost you a lot of money over time. I hope you guys enjoy that.